According to a recent report by the New York Times, banks are shutting down personal accounts without prior notice, leaving individuals without access to their funds. This comes as the ongoing credit crisis continues to plague Americans financially, prompting banks to take measures to mitigate risk, even if it means inconveniencing their customers. As conditions in the financial sector worsen, many institutions find themselves in a difficult situation. Adding to the mounting financial anxiety experienced by U.S. households, research reveals that 36% of Americans have no savings, with approximately two-thirds reporting an increase in household expenses during the past year. In contrast, only 25% say their income has increased over the same period. Consequently, concerns are growing about consumers' financial health, given the tightening credit conditions and rising levels of unemployment. A survey conducted by Clever Real Estate discovered that 51% of Americans would run out of money within a month if they lost their income, and 29% would face financial difficulties within a week or less. Matt Brannan, a data writer from Clever Real Estate, highlighted the alarming lack of savings among most Americans. Similar levels of savings were last seen just prior to the 2008 financial crisis. With insufficient savings to rely on, individuals face the risk of bankruptcy in the event of job loss or unexpected expenses. Even more concerning is the possibility of having one's bank account terminated without warning if income is lost, and debts cannot be repaid. The New York Times reported a significant increase in the number of clients being dumped by their banks. While banks do not disclose specific data on the frequency of such actions, analysts have observed a 50% surge in suspicious activity reports, which often result in banks cutting ties with customers without notice. This leaves affected individuals unable to withdraw their funds for extended periods of time. Real-life examples have emerged of customers being abruptly dropped by their banks, often without justifiable cause. This unfortunate situation has impacted businesses, students, and everyday individuals who unknowingly triggered certain bank protocols, forcing them to wait patiently for the return of their money. The recent trend of banks shutting down accounts and cutting off financial access for Americans has had detrimental consequences across the board. When credit cards are closed, individuals find themselves unable to pay their bills on time, resulting in potential damage to their credit scores. Meanwhile, small businesses struggle to meet payroll obligations and must explain to vendors and partners that they are temporarily without a bank account. The bank's justification for these drastic measures is rooted in the concept of de-risking. From the perspective of bankers, customer accounts flagged for suspicious activity could lead to fines or regulatory investigations. Thus, it makes sense to sever ties with these accounts. However, the toll on individuals is severe. As one person involved in the process stated, there is a complete lack of human empathy in these decisions. Instead of recognizing that a customer may be a single mother running a babysitting business, banks simply see a box checked for a red flag and proceed to terminate the account. Customers who have delinquent records face the highest risk of having their accounts shut down. The increasing amount of debt shouldered by Americans in recent years, coupled with rising interest rates that make loans more expensive, has made it increasingly challenging to escape the burden of debt. Simultaneously, banks continue to tighten their lending standards, making it harder for individuals to access loans. This reduction in available credit is detrimental for millions of struggling consumers, especially as pandemic aid diminishes and inflation increases the need for additional financial support. According to the Federal Reserve Senior Loan Officer Opinion Survey, banks slashed millions of lines of credit in the third quarter alone. This constricting credit environment has left households and businesses in a precarious position, desiring additional borrowing but fearing that current interest rates make it unaffordable, or that their loan applications will be denied. Considering the crucial role credit plays in the U.S. economy, it is becoming increasingly likely that the country could enter a full-blown recession in 2024. In the third quarter, there was a slight slowdown in the demand for loans due to higher interest rates. The tightening lending standards by banks dropped to 33.9%, compared to 50.8% in the second quarter. It is important to note that this is an incremental change, meaning that the 33.9% is in addition to the 50.8% of banks that tightened lending standards in the previous quarter. The credit crisis is impacting not only consumers, but also all major sectors of the economy. Banks have reported tighter standards across various loan categories, including commercial real estate, residential real estate, credit card, automotive, and other business loans. Several factors have influenced the decision to limit borrowing to businesses, including a less favorable and more uncertain economic outlook, reduced risk tolerance, and a deterioration in the credit quality of loans. Additionally, concerns about funding costs, legislative changes, accounting standards, and deposit outflows have contributed to these tightened lending standards. Bank deposits have experienced a decline for the sixth consecutive quarter, with a decrease of $174 billion in the third quarter alone. Major banks such as Bank of America, Wells Fargo, and J.P. Morgan Chase have reported lower deposit amounts. Furthermore, banks have faced significant market losses of $620 billion on their Treasury bond portfolios this year. The recent fall in Treasury bond prices will only further add pressure to their financial situation. U.S. bank stocks have reached an all-time low compared to the S&P 500 index in 2023. The relative performance of the S&P 500 Banks Index compared to the broader benchmark is at its weakest point since data tracking began in 1989. Over the past 11 months, the S&P Banks Index has fallen by 12%, while the benchmark S&P 500 has risen by approximately 13%. While credit cycles are a normal occurrence in a market economy, the present situation is far from ordinary. This is primarily due to the fact that the easy credit phase was fueled by an extremely loose monetary policy, the most lenient since 1946. The Federal Reserve responded to the economic impact of the pandemic by cutting interest rates to historic lows and engaging in an extensive money printing initiative through its quantitative easing program. As a result, over $4 trillion in liquidity flooded the market, increasing the broad money supply by 40% from March 2020 to December 2021. Although this injection of funds aimed to stimulate lending, it inadvertently led to reckless lending practices. The low interest rates failed to adequately compensate lenders for the risk associated with defaulting borrowers. Desmond Lackman, former deputy director of the International Monetary Fund, IMF, explained that such easy monetary policies tend to breed complacency within the financial system, resulting in irresponsible bank lending practices. When the music of easy money stops playing, the weaknesses and vulnerabilities of the system become apparent, leading to a wave of defaults that strain the financial system. In this case, the music abruptly ended when the Federal Reserve recognized that it had triggered the worst inflation spike in 4 decades. Over the past 18 months, the central bank responded by raising interest rates by 525 basis points. It transitioned from a policy of flooding the market with $120 billion a month in liquidity through quantitative easing to an approach of draining $95 billion a month through quantitative tightening. Last week, the Federal Reserve, Fed, announced that it is closely monitoring potential losses at banks resulting from the commercial real estate sector. For the past few months, U.S. bank regulators have been expressing concerns about this sector. Amid the surge in remote working, commercial real estate loans at U.S. banks have reached their highest point in the past 10 years. The office sector, in particular, has been heavily impacted as fewer people return to physical workplaces. According to Bankridge data, the volume of loans in which property owners have missed more than one payment has risen by 30% or $4 billion to $17.7 billion in the last quarter alone. This figure has skyrocketed by $10 billion in just 1 year. Experts predict that the number of distressed properties will continue to rise. Bill Moreland, the head of Bankridge Data, has described the situation as an ugly state of affairs in commercial real estate lending. Leo Fang, who heads commercial real estate debt at Ellington Management Group, has emphasized that the challenges faced by the sector are not temporary or related to the COVID-19 pandemic. Rather, they represent a deep-rooted issue. Fang warns that property prices will decline, while loan delinquencies will continue to rise. Kevin Fagan, the head of commercial real estate economic analysis at Moody's, anticipates an increase in delinquency rates for at least the next year. He emphasizes that there is more hardship to come. The recent bank failure of Citizens Bank has added to the mounting concerns. The government shut down the bank due to financial losses and handed control of the institution to the Federal Deposit Insurance Corporation, FDIC, without issuing any public warning. Citizens Bank marks the 5th bank collapse in the country this year, joining Heartland Tri-State Bank, First Republic Bank, Signature Bank, and Silicon Valley Bank. This latest failure raises doubts about the Fed's decision to maintain high interest rates for an extended period. It appears that these rates are more detrimental than beneficial to the economy. It is puzzling why policymakers continue to withdraw $95 billion per month in market liquidity, especially when the Treasury is struggling to secure reasonable interest rates for its financing needs.